U.S. equities are bouncing this morning, but our next guest sees trouble on the horizon. In fact, the word disaster is being used in his assessment of the Dow Jones Industrial Average. J.C. Parets, founder and president of Eagle Bay Capital, joins us now. He's also the blogger at allstarcharts.com. J.C., let's look at the Dow. We've got the chart. We've got lines drawn in. One is a pretty important support level, it looks like. And you've also drawn in the 200-day and another line, which is kind of the uptrend line. What does all this tell you?
Well, last week we actually tested a very important level. You know, for argument's sake, let's call it 17,150 or so on the Dow Jones Industrial Average. And if you recall, this was key support last December, about a year ago, and again in February. And then we went off and rallied a little bit into the spring. So we retested that yesterday. But what's more important, I think, is that we have an uptrend line from the August lows that's been tested 4 times. So the more times a level is tested, the higher the likelihood that that's ultimately going to break. So if that does break, we'll call it last week's lows. If we're below those levels, that puts us below all that support I just mentioned from a year ago, as well as the uptrend line. And what that's going to do is it's going to allow that 200-day moving average to start to slope much lower, and we're going to have prices trading below a downward sloping 200-day moving average. So when I say it's going to be disastrous, it doesn't necessarily mean that the market's going to crash. It's just going to mean that we need a lot more time necessary before and if we ultimately go on to make new highs. So a best case scenario is that we go nowhere for a lot longer. So that's why I would say it's disastrous, with obviously the potential that we do go a lot lower.
Just by the way, that's the Dow, of course, 30 stocks. It's an average. Is there a similar setup for the S&P 500?
100%. And, you know, a lot of money managers and whatnot refer to the S&P 500 because it's a much more broad look at the overall market. But Francis, I've done the math a million times. The correlation between the S&P and the Dow are through the roof. I mean, it might as well just be 1-to-1. So although there are fewer components, they move together.
We'll also have something else you're looking at, and you've been talking about this all year long, but is this relationship between bonds and stocks. And we're looking at a relative or a ratio, I guess, of TLT, the long bond ETF, divided by the spider, and bonds have been outperforming here.
Yeah, I mean, this is just a very simple, every investor, you know, is exposed to this. It's basically stocks versus bonds. It's that simple. Stocks represented by the S&P 500, and bonds, the representative is the TLT, which is a little bit more longer dated U.S. Treasury bonds, which one compared to the other. And that ratio bottomed out 2 years ago at the end of 2013 at the exact same level that we bottomed out in 2007, right before the financial crisis. So I continue to believe that Treasury bonds keep outperforming the S&P 500 as it's done over the last couple of years. It also pays a higher dividend. So if you're going to be in one over the other, I think that Treasury bonds are where you want to be. You can also go on a pair trade where you are long bonds, short the S&P 500, kind of continue to take advantage of that spread in relative performance of bonds compared to the overall market, for sure.
Just to give you a pat on the back, you're probably the only guy at the beginning of the year that was saying that bonds might be the better place versus equities, and you certainly lived up to that call. The other thing is for 2016, and we're going to talk a lot, I'm going to hear a lot, I think, from people who are on the recession camp or, you know, the bear market camp. But it's on the recession camp that this next chart's important. This is the yield curve, 10s minus 2s, 10-year yields minus 2, and it's starting to flatten.
Yeah, that's right. And it's been flattening for a few years now. And, you know, traditionally during good economic times, you get paid more to have longer maturity bonds, you know, so the yield curve slopes higher. So a 2-year or 1-year note is going to pay you a much lower yield than, say, a 30-year. And that's your traditional yield curve. However, when that starts to flatten out, that's worrisome, and it's been flattening. So we could just use a benchmark 10-year yield, which is sitting right around 2.2, which is basically where it was a year ago. And you can compare it to their shorter-term bonds, the 2-year yield, and all it does is go straight up. We're hitting 5-year highs over the last week. So you're seeing shorter-term bond yield yields exploding to the upside well before the Fed ever did anything. The Fed follows the market. So the shorter term yields continue to skyrocket, and then the longer dated bonds, the yields aren't going anywhere. So that's why you're seeing that flattening. So on the 10s minus 2s, which is the chart that you just put up, that 1.2 is the spread, right? Mm-hmm. So you got 2.2 on 10s, and you got about 1 on the 2-year yield, so 1.2. If that breaks, Francis, which I think there's a very high likelihood that it's going to break, I think that we're headed towards inversion of the yield curve. And, I'm not Mr. Economics over here, I'm about the market, but since 1960, an inverted yield curve has come before every single recession on record. So, again, I'll leave that to the economists. We'll worry about the market. The market keeps telling me short-term yields are going higher, longer-term aren't going anywhere. So inversion, here we come.
JC, just before we let you go, Apple closer, well, it's well off its highs. It's flirting with its 52-week low, not today, but closer to it than not. You don't like this name?
No, I haven't for a while. You know that it hit our target in February, and it's been a fade ever since. And then once we broke this summer, it's even worse because now we're below that uptrend line from the 2009 lows. That's a problem. Lower lows, lower highs is not an uptrend, Francis. So I still think Apple's a short. It's been a great short for most of the year. And I think we're heading back down towards the 90s.
JC Parets, we heard it here first from you. Thank you very much. Happy holidays.
Thanks, Francis.
Eagle Bay Capital and allstarcharts.com.